Hi, and welcome to the 2020 Economic Depression and Preparation channel. I'm your host, Tony. Thank you for joining me once again. Please hit that subscribe button if you haven't already subscribed to get the latest financial news from the United States and around the world. Today, I want to talk about the stalled recovery in the sense of both the pandemic and the housing recovery and the jobs recovery. All three are stalled out in the fourth quarter as we begin this fourth quarter, the last quarter of the 2020. And as we have anticipated, the number of mortgages in the coronavirus bailout program jumps 21,000 after declining for 6 straight weeks. So here we have a situation where the mortgages in this bailout program that the Federal Reserve Bank has created has jumped up. The numbers have jumped up by more than 21,000 people now. But I thought that we were on the recovery. I thought we were getting ready for a K-shaped recovery. I thought things were going well. Things are not going well because we haven't got over the first wave of this sickness virus, and now we have the president and the first lady who are recuperating or resting at the Walter Reed Medical Military Facility, as we know. So as of Tuesday, roughly 3.6 million homeowners remain in the forbearance plan, the mortgage forbearance plans, which, by the way, end December 31st of this year. That's 6.8% of all active mortgages, representing $751 billion in unpaid principal. The government and private sector forbearance programs, they were initiated beginning at the start of this whole pandemic back in March, allowed borrowers to delay their monthly payments for at least 3 months and up to a year. What they do is they allow you to forbear your mortgage payments, but that's going to be tacked on to the end of your mortgage. So you'll be paying for your mortgage a little bit longer than the traditional 30 years and some months or 15-year mortgage to your heart's desire. Houses in San Diego, in the North Park neighborhood of San Diego, California, was surging back in the beginning of the pandemic. And now, as the mortgage rates were low, mortgage rates set around 2.86%. Now, that is no longer the case as Americans are filing for mortgage forbearance with Freddie Mac and Fannie Mac. And as we predicted before, ladies and gentlemen, this housing market is primed for a crash. This is going to be one of the last dominoes to fall next year, and it's going to be absolutely a bloodbath out there. If you have the money and the resources and capital, for some of those people, the top 1%, they're going to pick up a lot of these condo properties, a lot of these multifamily properties, and a lot of these single-family homes for pennies on the dollar. And this is all by design. This is intentional. This is an intentional crashing of not only the economic system, but the political system, the fabric of America, the middle class, the bread and butter of America. And so, as of the 29th of September, the month we just end, nearly 800,000 forbearance plans were still set to expire in September. That's down from 2 million at the start of the month. The data is still coming in, but over the past few weeks, we've seen a roughly 80% extension rate. That's crazy. Now, given that there are another 1 million plans for which October marks the last payment covered by forbearance, we should expect to see heightened levels of expiration extension activity in the coming weeks. Well, no duh. You're kidding. No kidding. You're not telling us anything new here. This is according to Andy Walden. He's a senior director of market research at Black Knight. Yeah, we're going to see an increase. Now, beware of October. Remember, October was the month that 1929 that we had the Great Depression, right? And we're going to see a lot of volatility on the stock market as a result of this. And precious metals would happen to rise this month, as well as cryptos and other appreciative assets like land that you own or a farm that you own that some people may own. That's going to be very appreciative assets in a time of trouble as we go through this time of trouble. So now we have 3.6 million homeowners in the forbearance program, with another probably 5 million coming up after the end of October that's going to be into this active mortgage forbearance program. And it's very troubling because FHA and VA, FHA, which is Federal Housing Administration loans, and the VA loans, the veterans loans to get the veterans, they generally go to borrowers with lower incomes and lower down payments, are not recovering as well as the rest of the market. You would think that those people, would generally get those loans and do well for themselves. But it's likely that these borrowers are in jobs that have been hit hardest by this pandemic. It's impossible to know specifically why more borrowers suddenly need more help on their mortgages, but it's a sign that all is not improving in the housing market. Some borrowers have been dipping into their savings to make their monthly payments. Others have been refinancing their houses to get more cash out as an ATM. So while the unemployment rate is still hovering around 10%, borrowers are clearly struggling. 4.7% of all Fannie and Freddie backed loans are in forbearance, while 11.2% of all FHA and VA loans are in. For private label and bank held loans, that share is 7.3%. And ladies and gentlemen, as we get deeper into this collapse, this depression, you have to remember that if a person doesn't have a place to stay, and if a person doesn't have food, they're likely to do anything. And that's why security is going to be of utmost concern for the next coming months. And that's why I feel the National Guard is going to be activated. They're getting ready to get security ready in a lot of these states, not just for the national disasters that we've experienced with wildfires in some parts and floods and all of that, but they're getting ready. The country is getting ready to experience internal turmoil, internal conflict, as a result of more than 1 million people losing their jobs every single week in this country. And when the person doesn't have food, when the person doesn't have a place to stay, once again, they're likely to do anything. And that means coming after those who are preparing for this collapse, you and I and others, okay? So please be safe out there. Try to continue to secure, fortify what is yours, because those who do not have are coming for your stuff, or maybe sending someone else a proxy to come for your stuff. So, and we have to keep in mind too that the flight attendants, airline pilots, and other aviation workers, they held a strike yesterday up in Washington D.C. because remember, their jobs are being cut as of the first. That's a couple of days ago, the first of the month. So things are not looking good in all 3 or 4 of these sectors. The Dow Jones is an illusion, and I expect more drops this month than gains. And this whole economy is on its way down. And so it's just a matter of time before the collapse coming up in 2021, that first quarter, when reality hits in that no stimulus check is going to fix, no $1,200. There's no amount of paper money that's going to fix what's coming. That's why we have to get prepared. So the time to play on the beach and do vacations, and the time to do all those things is over. The time now is to prepare for you and your family, to have a plan, a contingency plan, because the government is not coming to save us. They already have their contingency plans. The rich folks, the upper 1% of 1%, have their contingency plans. And now it's up to us to secure the basics of life: housing, food, security, water, medicine, and survival skills. That is the new currency for the next 10 years of America, 10 to 12 years of America's existence going forward in 2021 forward. No matter who's in office, no matter what we believe in, this is going to be the hard road up the mountain for most American families. Stay blessed, everyone. Stay prepared. If you have any questions or comments, leave them down below. Be sure to get back a few. Thank you very much for listening.